Too many people associate retirement with the end.
I figure it'll be a little bit of a transition to try to slow down a little bit.
The number one question I have about retirement is having enough money to last.
In my mind, you start to look at it, that's an opportunity to do more of the things you want when you want to do it.
Make it financially able to do things that I enjoy.
Party.
Just financial security and enjoy my family.
More people need to go into it with their eyes wide open, understanding what is my plan, what do I want to do, and then how am I going to get there?
Will the rules change?
I have no real specific plan.
I'm planning for what the status is right now. I just hope it doesn't change drastically.
Welcome to the RetireTastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. In retirement, it's all about income. And today, you'll hear ideas, concepts, and strategies designed specifically to generate reliable retirement income. Now, here's the host of the RetireTastic Show, Joanne Regan.
One of the reasons that I do this radio show is to educate you, my listeners, on financial matters, of course. And I want my listeners to have a clear understanding about the words risk and reward. It's easy to say higher risk equals higher reward. However, that's not always true, is it? Think about it. If everything that had a high risk yielded higher rewards, why wouldn't everyone take more risk? So welcome to today's edition of the RetireTastic Show, powered by the Retirement Income Store. Thanks for joining me. I'm Joanne Regan, your host, where my goal is to help you have a fantastic retirement. I'd like to start off the show today with a couple of sound bites about risk in your portfolio. Here is economist and professor Patrick Kelly recently talking about taking on risk because it's exciting.
I mean, if you want excitement, if you don't do it in your financial portfolio, go to the amusement park and ride a roller coaster. Get on a racetrack and drive a race car. Jump out of an airplane.
How many times have you heard that one? Probably never. We've been taught that investments need to be sexy, the latest and greatest fad. What a bunch of garbage. Next, I'd like you to take a quick listen to John Najarian recently talking about how the market is even more risky than previously.
Clearly with the market, I think I would be dumb if I said, oh, it's not more risky now. It's more risky. I'd be dumb if I said, oh, yeah, there's less risk.
Now let that sink in just a bit. Exciting risk is not smart, and the market is risky. So why do we hear over and over and over, you have to take on higher risk to get the rewards of the market? The truth is, higher risk doesn't always mean higher rewards. You can actually lose money, actually all of your money. It happens. To be clear, you need to be willing to accept both the risk and the reward if you're going to jump in. And if you don't understand both, it can be very dangerous. Here's an example. Everyone remembers Iron Mike Tyson. So if I were to get in the ring with Kid Dynamite, I might be able to survive a round with him doing the rope-a-dope thing. But do you remember his early days? 12 of his first 19 wins were by knockout or technical knockout in the first round. So knowing that, why would I take that risk of even getting into the ring with him? Well, I wouldn't unless the reward was greater. Maybe if the purse was $10 million for just jumping in the ring. If that were the case, at least after I recovered from the hospital and went through some physical therapy, I might have something left to show for it. That $10 million might be worth that risk. At least there's a choice there. The same is true with your investment strategy. The difference is many people misunderstand the risk that they have in their retirement accounts, and they're invested the wrong way. And that's why we're going to spend some time today helping you get a clearer understanding of risk versus reward in your portfolio on today's episode of the RetireTastic Show. So let's think about the word conservative. You might actually consider yourself to be a conservative person in many facets of life, and you don't like to take much risk. And so in the financial planning world, conservative to one advisor may be significantly different to what your needs are, depending on what the advisor's business model is. You have to know the difference, and we're going to explain that to you today. Most advisors, although they are well-meaning, define risk for their clients based upon relative risks of various mutual funds compared to the same type of stock market index. You probably are familiar with the S&P 500 or the Dow Jones. And that's actually okay when you're in your 20s, 30s, and even 40s, when you're in the accumulation phase. And that buy low, sell high strategy with common stocks and mutual funds is actually perfectly acceptable because you don't need income. That's the growth strategy, and it will likely work out fine since the stock market does recover. And when the market is down, you buy more shares, and that's called dollar cost averaging. But I want you to understand that that's not always okay throughout your entire life. Usually when the stock market drops, there are certainly relative levels of risk. There are the small caps that are affected more than the large caps or bond funds, which usually drop less when the stock market goes down. Let me give you an example. Back in the tech bubble of 2000 and 2003, and even during the financial crisis of 2007 and 2009, what happened? The stock market dropped by about a 50% average. Everything dropped because people took their money out and put it in cash, or they took it out of the market altogether. In the accumulation phase, it doesn't really matter because you're still working. And you're that disciplined investor. You're saving money every week and every month. And when the stock market is down, although you're not happy about it, you buy more shares. That's dollar cost averaging. When you do that and the stock market rises, because the market does always come back, you're going to have more shares in your retirement assets that are going to rise up in value, and that's going to grow your nest egg even faster. Where the problem comes in is when you need to get income in your distribution phase of your life. When you're invested in things that are designed for growth, that buy low, sell high strategy in the accumulation phase is where you're going to have a major problem. And you're going to have to make sure that you understand what risk really means and how it can affect you when you're trying to take income. Here, timing is everything. And how do you understand and choose the right type of investments to match the right type of risk? Well, I have something for you today that can help in that arena. It's a commissioned report titled 7 Risks to Your Retirement. And this report clearly lays out not 1, not 2, not 3, but 7 risks in your retirement. 7 items you need to not only know about, but understand how to deal with. And I'd like to get this valuable information into your hands. And the best way to get that is to reach out to me at 1-800-FSG-7890. Ask for the commission report titled 7 Risks to Your Retirement. Again, 800-374-7890. So I'm Joanne Regan with the RetireTastic Show. And how do you understand and choose the right type of investments to match the right type of risk? Well, that's what we're going to address next. Stay right there.
This is the RetireTastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Whether this is the new normal or the new right now, our economy has changed. So what does this mean for your retirement? To keep you up to date and informed, we've put together a series of webinar events because even though many things around us keep changing, your need for retirement income will remain constant. For the date and time of our next webinar event,
call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com. Welcome back to the RetireTastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
Thanks so much for listening in today, and I'm really glad that you're here. So today, we are defining risk and reward so that you have a crystal clear understanding of what that means. Not what your advisor says it means, but what you mean. So welcome back. I'm Joanne Regan, your host. This is the RetireTastic Show, and my goal is to help you have a fantastic retirement. So if you missed the first part of this show and you're going to want to visit my radio archive on my website, and that's yourfsg.com, and just click on the RetireTastic tab, and you can revisit this show or previous shows anytime. So before the break, I was talking about risk and reward. And the reality is more risk doesn't always guarantee more reward. It simply means that you may not have any reward at all. You can lose your investment, and that's the risk. Why would I take on more risk if there wasn't the opportunity for more reward? Like I said earlier, I might be willing to jump into the ring with Mike Tyson and risk a long stay in the hospital if the reward was a $10 million purse just for doing it. That's a possible trade-off. However, in retirement, your needs change. So when you approach or enter retirement, you need to replace at least some of the growth in your portfolio with income. And I mean real income, not just fabricated or manufactured income. Most financial advisors will manufacture income by selling shares of your mutual funds or bond funds and telling you that your mutual funds are paying interest or dividends. The fact is, traditional common stocks and mutual funds don't pay much true income in the form of interest and dividends. Before the financial crisis in 2008, the average common stock dividend yields were above 3%. However, since then, dividends have dropped to about 1.35%. So let me put that in perspective. If you have $500,000 invested in dividend-paying S&P common stocks and you've collected income only, in other words, dividends from your portfolio, your income would have gone from $15,000 in 2000 down to $6,000 in 2021. That means your income is dropping and prices have gone up. Prices on food and your living expenses have gone up, and we've had 50% drops in the stock market during that time period. So if you had to sell shares to keep your income up with inflation, you'd be selling twice as many shares at the bottom of the market, and you risk running out of money before you run out of life. If you're not sure if you have the right level of risk in your financial plan, I can help you figure it out. Why don't you give me a call at 1-800-FSG-7890. Yes, that's 1-800-374-7890. As a fiduciary, I'm going to sit on your side of the table helping you build your tomorrow with plans that you need to make informed decisions about your retirement and your financial plan. So next, we're going to be talking a little about assessing risk in your financial plan and making sure you have the retirement designed to support your goals. When you retire, you have to replace your salary, and that means steadily generating income to supplement your Social Security. And if you're fortunate enough to have a pension, then that's even better. That means your investment tools need to be generating interest and dividends. At least that's true with a portion of your portfolio. Again, every situation is going to be a little bit different, and the only way we're going to be able to know how that works is if we talk to each other. And as I talked about earlier, the average dividends for S&P 500 companies is about 1.35% right now. And if you pay your advisor the average fee of 1%, that doesn't leave much income for you. In fact, that puts you in a very vulnerable position depending on the growth of the stock market. I'd be very happy to help you determine the actual risk in your portfolio and provide you with the visibility and the confidence you need to accomplish your retirement goals. Plus, I have something for you today that can help in that arena. It's a commission report titled 7 Risks to Your Retirement. And this report clearly lays out not 1, not 2, not 3, but 7 risks to your retirement. 7 things you need to know about and how to deal with. And I'd like to get this valuable information into your hands today. All you have to do is call me at 1-800-FSG-7890 and ask for that commissioned report titled 7 Risks to Your Retirement. Risk can be misleading. It has different meanings to different people. And you have to make sure that you have the right definition of risk in your financial plan so that you can enjoy the stress-free retirement you've always dreamed of. So next, what I'm going to do is I'm going to answer some questions. I'm Joanne Regan, and I'm going to get to those questions in just a moment.
The RetireTastic Show with Joanne Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. You're listening to the RetireTastic Show with Joanne Regan, powered by the Retirement Income Store. Have you missed any of today's program? No problem. You can hear all of the RetireTastic Show online anytime, 24/7 at yourfsg.com. That's yourfsg.com.
Investing in the stock market these days is like riding a roller coaster. 1 minute you're moving up slow and steady just the way you like it, and then all of a sudden, Your investment portfolio is in a free fall, up 800 points, down 800 points. It can be very scary. A lot of people no longer gamble with their retirement in the stock market. If you are tired of the ride and want to look at safer options or would like to learn a better way to grow your money during these times,
call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com. Time now for more of the RetireTastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
So my first question came from Don, and he said, my dad recently passed away and left me his house worth $300,000 and an IRA with $350,000. He bought the house many years ago for $30,000 and I'm the only beneficiary. How can I minimize the taxes on these assets? And is renting the house a good idea? So let me answer the first question. On the IRA, unfortunately, you don't have much choice. All of that money, that $350,000, is going to be taxable, and you have 10 years to take it out of the IRA, Don. Unfortunately, not a whole lot you can do about that. But with the house, let me help you out here. Because you inherited the house, there shouldn't be any taxes because there's what's called stepped up basis. And you as the beneficiary, you get to, for tax purposes, you inherit the house at fair market value, not at what your dad bought it for. So if you hold on to it for 10 years and it grows to $400,000 in value and you sell it, then you're going to have to pay taxes on the difference between what it was worth on your dad's date of death, which was $300,000, and the sales price of $400,000. And so what does that mean? You're going to pay capital gains tax on $100,000. Now, the question is renting the house a good idea or not? Well, my answer is maybe yes, maybe no. It depends. If you've never been a landlord before, you certainly want to do some due diligence and make sure it is going to give you the return that you need in order to generate some cash for you. Because renting a house or being a landlord can certainly provide cash flow and good income. In fact, the rate of return can be very high relative to what you may be able to do with other types of investments. However, there is always a trade-off, and that trade-off is you may have to deal with bad tenants, or you may have to deal with the cost of getting a new air conditioner or a new roof or some very expensive repairs to make sure that the house is in good order for your tenants. So those are things that you want to keep in mind. And if those fit into what your retirement plans look like, then it's a good decision to keep it, or you can also sell it and maximize your returns that way by investing the money. My next question is from Mark, and he says, I've heard you talk about investing for income rather than growth, but when I look at the alternatives, the rates aren't very good. What are some of the options that pay a decent income? Well, Mark, you know what? That's a great question. The reality is there's a whole universe of income-generating investments. The thing is, it's not like a mutual fund or a common stock. Those are things that you typically purchase to buy low and sell high. You can purchase anything from individual bonds that pay a reasonable rate of interest to bond-like instruments like preferred stocks or exchange-traded debt securities. Those things are traded and pay a fixed, reliable income stream. You could use other alternatives too, like fixed or indexed annuities, to provide guaranteed reliable income if you need that. Outside of those things, you also have other options that kind of move up a little bit on the risk scale, but can also provide more income. Things like business development companies or BDCs, or real estate investment trusts known as REITs, or even using some value stocks. All of those things can provide you with a relative amount of income. Again, the allocation would be included in your individual portfolio, and you would have to be willing to accept risk, and we would need to know what your time frame was. If you only need a small amount of income, but you're able to take some additional risk with your portfolio, then you could allocate more money towards growth investments, things that you don't need to touch for 10 years or more. There really is a whole spectrum of things that you can do. But here's the caution that I have for you. I talk to a lot of folks who are do-it-yourselfers in the accumulation phase, but when it comes to understanding the universe of income-generated investments, let me tell you, it's a whole different ballgame. It's a specialty. It's kind of like asking a general practitioner to perform knee replacement surgery. It's just not a good idea. You know what, Mark? I'm really glad you asked that question. Thanks so much. My next question is from Erica. And Erica says, I'm 64 and I want to retire. If I start Social Security now, it'll be about $2,000 a month. But if I wait until 66 and a half, it'll be $2,300 a month. And I'm not waiting until 70. I am single. I have $400,000 in my retirement account, and I only need about $30,000 a year to live on. Should I start Social Security now and retire, or should I wait until full retirement age? Well, Erica, listen. The first thing is I don't really have all the information to answer your question thoroughly, but I'm going to give you just a few bullet points to think about. You've already latched onto the fact that it's going to cost you about $300 a month if you start taking Social Security right now. And that $300 a month could end up being $70,000 or $100,000 over the course of your retirement, depending on how long you live. The key is one, do you like your job? Are you happy where you're working? Or are you just fed up and want to move on? Well, with $400,000, you can certainly generate a little bit of income, maybe about $16,000 worth of interest and dividends from that $400,000, but that's not going to be enough if you say you need that $30,000 to live on. So if you don't start taking your Social Security right now when you retire, you're going to have to tap into your investments. And over the next couple of years, up until full retirement age, you may end up taking out, I don't know, $30,000 or $40,000 of your overall retirement assets, depending on what the market does. So you want to be really careful. If you decide to start taking Social Security now and retire, then you're going to want to make sure you reposition your retirement accounts or that $400,000 that you have so that you're generating interest and dividends so you don't have to tap into your principal. You don't want to sell shares. Most of the time I see people in your situation where, look, you're 64 now, 2.5 years from now, it's not that long. It could make $100,000 difference in your Social Security over your lifetime. So weigh that heavily. If you're just fed up with your work, there are some ways that you can make that jump right now and still mostly be okay. So let me encourage you to give me a call at 1-800-FSG-7890 and let me nail that down a little bit further for you. I also have something for you today that can help in that arena. It's a commission report titled 7 Risks to Your Retirement. And this report clearly lays out 7 different risks to your retirement, 7 things you need to know about and how to deal with. And I'd like to get this valuable information into your hands today. And the best way for you to get that is to give me a call at 1-800-FSG-7890. Now, we all know that risk can be very misleading. It has different meanings to different people. So make sure you have the right definition of risk in your financial plan so that you can enjoy the stress-free retirement you've always dreamed of. So listen, that's all the time I have for this week. Please tell a friend about the show. The more people listening, the more people we can help prepare for the retirement they deserve. And quite frankly, if they are not utilizing our education and our methods, they simply may not achieve their desired retirement. And that's really sad and unfortunate. But I'm here to help you, and I look forward to speaking with you off the air. It's always my pleasure to talk to my clients. So thanks for listening, and have a great week.
That's all the time we have for today. To speak with JoAnn off the air, call 800-FSG-7890. And for more information about our program, visit yourfsg.com. The RetireTastic Show with Joanne Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. To speak with JoAnn off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com.
Investment advisory services offered by FSG Financial Services, Inc., a registered investment advisory firm in the states of Arizona, Nevada, and California. Sound Income Strategies, LLC, an SEC-registered investment advisory firm, is a sub-advisor of FSG Financial Services, Inc. FSG Financial Services, Inc. and Sound Income Strategies, LLC are not associated entities. FSG is a franchisee of the Retirement Income Store. The Retirement Income Store and Sound Income Strategies, LLC are associated entities.